Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but explain crazy days like today. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, the market has officially lost its mojo. So we're back to loving tech and just tech and not much else. That's how I feel after the Fed meeting today. After it broke up with Fed Chief Jay Powell explaining why policy is staying the same, there won't necessarily be a rate cut on the horizon. Not happening. Most of the market could benefit from a rate cut, but it would mean very little to companies like Microsoft or Meta, two hyperscaling members of the Magnificent Seven, veritable nation states that shot the lights out when they reported after the close tonight. I always find days like today mystifying. See, there's this camp. I'm going to call them an ill-informed segment because I used the word stupid too many times this morning, that somehow expects a surprise from the Fed, like a rate cut when it's least expected. They know nothing! Then when they don't get the surprise, what do? Sell. Which is why the Dow only lost 172 points today. S&P shed 0.12%. NASDAQ actually gained 0.15%, though. I always say to myself, what are these numbskulls thinking? How can they be disappointed about something we all saw coming? The ironic part is that in the wake of their selling, we have a market that doesn't seem to have any oomph to it, aside from a handful of tech giants and their fellow travelers, like it's been for so long. We just say, you know what? All we're going to get is a boatload of attacks from the president against Chairman Powell, especially because there's no Fed meeting until September, for heaven's sake. So there's nothing that can be rectified. In the interim, it's just one more reason for Wall Street to freak out about the Fed losing its independence. But with the Fed meeting out of the way, we're back to worrying about earnings. And today we had a new wrinkle that rankled. See, the Fed chief, so worried about cutting rates too soon, did tell us the consumer ain't as strong as she used to be, and housing's weaker than it should be, and then he does nothing. Look, I totally understand why Powell wants to wait. By historical standards, it would be kind of crazy for the Fed to cut rates here. We got a healthy GDP growth, found out just today, much better than expected, and maybe even accelerating when it comes to tech spend. We have a strong labor market. We have very little indication of prices coming down, even if they're not going up as fast as they used to be. We've got new tariffs that, for the moment, are mostly being eaten by the companies that ship things to America. But what happens when they start passing their higher costs along to you, as they almost always do in the end? No Fed chief wants to be the guy who cuts too early and lets inflation make a comeback. But the president's demanding rate cuts yesterday. I get that, too. We have the intractable price of housing. It refuses to come down. And the possibility, just the possibility, that the consumer's truly slowing. We got weak numbers yesterday from Stanley Black & Decker, United Parcel, PayPal, and Whirlpool, which makes us wonder if we might be at the beginning of a slowdown. Today, though, no real follow-up. For instance, credit card giant Visa said business is quite strong. It's hard to say if business is slowing when a $700 billion market cap Visa is crowing about how things are looking good. Starbucks, which makes a pricey cup of coffee, if you ask me, told us this morning that business is coming back after a prolonged downturn. More on that one later. Again, it's hard to imagine that the economy is really getting worse if that's the case. In short, the backdrop's just too darn mixed for the Fed to take action. That's also why Powell pretty much punted on that forecast, because who knows what the heck the future's going to look like. Certainly not the Federal Reserve, which is why they're so reluctant to make a move until they know more. Yet we know the president won't let up no matter what, even if Powell's right. What does the president care? It won't be Trump's reputation that's tarnished if we get more inflation. It'll be Powell's. The president's got a free hand to say whatever he wants. Powell just has a number, a quarter point, a half point, or whatever, and he'll be hanged on that number if he cuts and inflation comes back. What does all this have to do with your portfolio? I got to tell you, I think it's a buzzkill for about 75% of the stocks in the S&P 500. If the broader market's going to keep climbing, and we wanted to so badly, I think we do need lower rates. There are whole swaths of the economy that aren't doing all that well, mostly connected to housing, but housing punches above its weight. But that is the real battleground. If you cut short-term interest rates, the rates that the Fed controls, and there's this much strength in the economy, what would happen to the long rates that mortgages are priced off of? Would mortgage interest rates go higher? I mean, will they go up or they go down? We don't really know. Do you know that rates went up on the long end when the Fed cut rates last time on the short end? Maybe we'll know more on Friday when we get the employment number. If it's weak, then the president's endless hectoring of Jay Powell might be a little more justified. But if it's strong, then we know there won't be any rate cuts from the Fed to help the stock market go higher. But remember, we're talking about the broader stock market. Let's talk about the stock market that continues to just climb like mad. See, we have to revert to individual tech stocks. And if you aren't, look, if you're just in an index fund, you can pivot right now to buy what's really smoking. And tonight we found out that the smoke's coming from Meta and Microsoft. Coming in earnings, the street was worried that Mark Zuckerberg might be paying too much for talent. But when we looked at the numbers, we had to laugh. Like a great baseball team owner, Zuckerberg can overpay all he wants. Meta's winning the championships with these numbers, which were sharply better than even the most bullish of Meta's Amen chorus. Plus, they gave us an amazingly strong forecast, much higher than expected revenue, with their capital expenditure budget coming in at the low end. Of course, what does that have to do with the Fed, right? Meanwhile, Microsoft also reported a monster top and bottom line beat with tremendous strength in their Azure cloud infrastructure business. Many people think that's the most important division, where growth accelerated from 35% to 39% in just 3 months. This is a huge business. That's incredible. Their AI business is on fire, too. The scale of the sales and earnings beat here were pretty staggering. I am shocked at the strength we're seeing here. Microsoft, like Meta, is spending fortunes on hardware and software, and it just keeps paying off. As always, we have to wait until the Microsoft earnings call, which is ongoing, to get the company's forecast and thus the full story. But the numbers that are reported for this quarter, they are incredible. But these two core Magnificent Seven companies do not relate much to anything that Jay Powell's talking about. As I call them, they are nation-states of their own. Aside from these heavy hitters and companies like NVIDIA that help them accomplish these astonishing results, you can't get the rest of the market moving up without some sign that the Fed will backstop us. Maybe we shouldn't even care. The bottom line, I think this market fell apart today because the Fed seems reluctant to give us that rate cut backstop. I didn't get the sense of the so-called inevitability of rate cuts that I felt from the last two Fed meetings. Judging by the action, not many others did either. But you know what? After the close, maybe Microsoft and Meta set us all right. Let's go to Sam in Massachusetts. Sam.
Jim, how are you?
I am good, Sam. How about you?
Good. You know, Jim, I'm calling you tonight not just as an investor, but as an avid distance runner who put over 1,000 miles in the on-cloud monster. See, after running in the shoe the first time, I was a real evangelist for the company. I even bought the stock, bought a huge position in On Holdings. But after running over 1,000 miles in their shoe, I noticed a design flaw that not just myself, but my friends have reported. The back of the shoe digs into the Achilles. Now, if they would fix this issue, this company has the best shoe in the world. But with this issue, I got issues with the repeat purchases.
Okay.
I'm worried. I'm worried about
Well, you know, let me tell you something. The reason why I like the stock is that they have adjusted every time that there's been a problem. Roger Federer and his team have adjusted. And I think that if there's really something that's lasting and negative, they will fix it, which is one of the reasons why I do like On. I am concerned that Nike may be making a comeback and take business from On, but I think On is a decent buy here. Let's go to Aaron in Illinois. Aaron.
Hey, Jim. Happy to be talking to you. I started investing 10 years ago, and since then I've learned so much from you and some of your colleagues at CNBC. I just wanted to say thank you for what you do.
Oh, and we thank you right back. That's terrific comment. Thank you so much.
I appreciate what you've been saying about it being an ideas economy, because I think there are so many exciting things happening. The company I want to ask you about is Intel, INTC. I got excited about this company a few years ago when they said they were going to go into the foundry, which I think is a critical need in this country to make these chips. And, you know, based on their last earnings report, it seems like they're flubbing it. So what's your take on the foundry, and what should I do about Intel?
Okay, the foundry was ill-advised. You're right, we need them in the country, but they are not necessarily profitable. And Intel, the previous CEO, was spending far too much on them. We have a new CEO at Intel. The CEO's name is Lip-Bu Tan, and he totally understands everything I just mentioned about foundries. He did make me feel that a turn is not yet at hand. It's still a little too early. If you started buying here, I think you're going to be able to just kind of break even versus so many others, including my favorite, NVIDIA. All right, listen, I didn't get a sense of any inevitability of rate cuts today like I have in past meetings. But you know what? The market didn't either. However, Microsoft and Meta kind of overwhelmed all the negativity at the end of the night. On Mad Money tonight, VF Corp, the parent of Vans and North Face, is up majorly after its better than expected quarter. I'm digging into the impressive report with the company's top brass. Then Wall Street is starting to see the vision that Starbucks CEO Brian Niccol planned for the coffee giant. I'm sharing why I also feel confident after last night's report. And Werner's quarter gave us a real look at the strength in the data center that I just referred to with Microsoft and with Meta. I'm getting a sense of the demand for AI-driven infrastructure with the CEO. And let me tell you something, it's pretty darn strong. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.